Corporate Finance OneNote Practice Problem. In this presentation, we're going to take a look at the formatting and the creation of a balance sheet. We'll take a look at the balance sheet in a couple different forms and different ways we can have the subcategorizations of the categories within the balance sheet and the presentation in a side-by-side type of format and a vertical type of format. Get ready because it's time to take a stance with Corporate Finance. Here we are in OneNote. If you would like to follow along, and you're not required to follow along, but if you have access to OneNote and would like to, we are in the 225 Balance Sheet Alternative Formats section under the Practice Problems tab. Closing this back up, we're going to have our information up top for the practice problem, and then we're going to be creating our balance sheet with it. Remember, as we go through the balance sheet, we've been looking at components of the balance sheet, thinking about balance sheet concepts, comparing and contrasting balance sheet accounts and income statement accounts. And now we're going to basically put the information into a balance sheet type format. This is different, slightly different from a finance class than what we would do in an accounting class. Remember that in an accounting class, we would be going all the way back to actual transactions, focusing in on the building blocks, debits and credits, the accounting equation, building a general ledger, building the trial balance, and then creating the balance sheet from that. We're not going to go all the way back to each individual transaction really with a finance class, because our goal is really to understand the balance sheet in such a way that we can then use it for decision-making processes. Therefore, when we put together the balance sheet, what we really want to do is memorize and understand, be able to view the balance sheet and know what the different components are of it, not be overwhelmed by the balance sheet, and because it can be a long statement if you first take a look at it, and then be able to pick and choose the components that you need for the relevant decision makings that you need to take as we consider and analyze the financial statement. So therefore, we're not going to be going back to the transactions here in this practice problem. We're not going to be looking at a trial balance. We're not going to be using the debits and credits. However, we will be considering the double entry accounting system in terms of the accounting equation, which will be assets equal liabilities plus equity. And from a finance standpoint, you typically think of assets minus liabilities equals equity, so that we can think of the emphasis on equity. However, when you're thinking about the balancing concept of the balance sheet, the accounting system is the way you really want to see it. Assets on one side of the side, which will be what the company owns, assets, and then the other side being liabilities and equity, meaning who has claim to those assets, either third-party individuals, liabilities, or the owners in the form of the equity section. So we're going to have our accounts up top. I'm not going to refer back to the accounts a lot. I'm just going to basically use these accounts to construct the balance sheet. So you want to be able to do this a couple different ways. You would like to be able to name these accounts, look at these accounts, and then know where they would lie in the balance sheet, so that if you see them outside the balance sheet, you can visualize where they would fall in the balance sheet and therefore have some concept of what they mean, because typically where they fall gives some idea of what they mean. Are they an asset? What does it mean to be an asset, right? If they're an asset, then you have some idea of what it means to be there. Liabilities, what does it mean to be a liability? You also want to be able to look at the balance sheet and then be able to kind of construct in your mind what accounts would be in the balance sheet in that section. We will have this problem in Excel as well. Highly recommend doing this in Excel. Highly recommend using this course and using finance in general to work on Excel, because Excel is going to be really helpful in the field of finance, accounting, business in general. Okay, so we're going to go down to the balance sheet. We're going to start to construct the balance sheet. Notice we're going to have two sides of the balance sheet. We're going to represent it in a two-side format. Then we'll look at how we might see it in a vertical format later. When you see it in a side-by-side format, you're typically going to have the assets on one side, and then the liabilities and the equity will be on the other side. In other words, the bottom line down here is going to be total assets equaling total liabilities and equity. That's what's going to tell us that it is going to be in balance. So that side by side is nice visually to see. It can be a little bit more painful to put together. You might often see it in a vertical type of format where you're not going to see it lined up quite so nicely, but it'll also often be presented in a vertical type of format. Okay, so let's go through this. We're going to go through the left-hand side first, which is going to be the assets, and then the right-hand side is going to be the liabilities and the equity. We'll start to just visualize the components and how a balance sheet might be structured. So when you think of the balance sheet, the first thing you're going to think of is the first component will typically be current assets. So notice the assets up top is a subcategory. That's going to be a category of the balance sheet, a major category of the balance sheet, which may be centered like this, or you might see assets and colons to represent that there's going to be subcategories underneath it that will relate to the assets. Also, just note we have the balance sheet up top. We didn't put a title on it, but the title would be as of like December 31st, as of a point in time. It's not representing a time frame, even though it will be presented with an income statement, which will. In other words, if you look at the financial statements for a year, the income statement will be for the year ended, meaning 12 months is being covered here. The balance sheet will be as of 12/31 because it represents where we stand at the end of that time frame. It represents a point, that point being at the end of the time that the entire financial statements are covering. Then we'll typically expect to see on the balance sheet the current assets. So notice this is not an account again. It's going to be current assets. It's a section. We'll typically put a colon in it. Now you could see some variance in different types of formattings of balance sheets, but you want to kind of know the standard formatting of it so that then you can understand that, and you can put your financial statements together yourself in some kind of standard way. So we would expect something like a current assets and then like a colon, which will represent the fact that everything under this section will be in the category of current assets. Then we're going to have cash is typically going to be the first current asset. Notice it's under the current assets section because it has a colon, then cash is actually an account. So we have the account and it's going to be indented here. So we've indented it to represent that it's in this category. And then I've got it here on the right-hand side. These two columns represent two columns because we're going to be subgrouping some areas in the enter column. These don't have anything to do with debits and credits. There are no debits and credits on financial statements. The financial statements represent the financials in a double entry accounting system represented by the accounting equation, assets equal liabilities plus equity. So then we're going to say the next account we would almost always expect to see is accounts receivable. That represents money that is owed to the company for work that was done. Typically, it's going to be on the books from the form that would be used and invoice. We did work, or we shipped inventory, and we've got a receivable that we expect to receive from the customer or client, usually within 30 to 60 days. We're going to pull this into the inside, into the enter column here. Why? Because usually, if you're talking about a publicly traded company, they might have lots of receivables. And if you have a receivable, the problem with receivables is that some people might not pay them, right? It's not money. You did work and you sent out an invoice. You didn't get the cash yet. The risk in doing work and not getting the cash at the point in time you do the work is that you may have some clients that don't pay you. So that means that we have receivables of $52,000, but typically the system or the regulations will require companies to then estimate how much of that $52,000 they believe is uncollectible. They're going to have to think about, well, based on past experience, we haven't collected on every receivable we've had, and we're going to have to estimate the amount that will be uncollectible. We call that allowance for bad debt. So of the $52,000, the company believes that, and therefore is reporting that $13,000 is estimated to be uncollectible. We're not going to get that. We don't know that, but that's our best guess. Then the difference between those two, then the $52,000 and the $13,000, we're going to pull out to the outer column. So we got an underline here. We're pulling that out to the outer column. So 52 minus the 13. Notice that this 39,000 is not taking into account the 14,000. Within the financial statements, you will only typically do something on one column at a time. Therefore, if there's some kind of sub-calculation on it, like this calculation, if there's nothing above it here, then we're going to move to the column to the left, and then we're going to pick up the column to the left. We're not going to typically bounce back and forth. We're not going to pick up these numbers and something over here in different columns, right? If there's something right above it, then we'll typically be staying in this column, and we won't be bouncing to the column to the left. If you understand these rules in general, it makes it a lot easier to start to read the financials, because your eyes don't start wandering all over and thinking like, well, what are they adding up this time? On this thing, where did they go? Did they jump, way over here on the financial statement? No, it's typically going to be just one column at a time. So then we're going to have the marketable securities. This may not be in every company might not have marketable securities. It depends if they have investments in some other stock. For example, if we had a lot of cash and we don't want to distribute it in terms of dividends, we might put it somewhere else. We might reduce the cash, put it into marketable securities, in order to put it somewhere that we might get some kind of short-term gain on it while we hold on to it until we're going to consume it or use it in the goal of the organization, which is revenue generation. If we have a lot of cash and we don't have any plans on using it, then we should give it to the owner, right, in the form of dividends, so that they could invest it in whatever they want to invest it in, assuming we're not an investment company, right? We do something else. Owner put money in to see revenue generation here, and if we have excess cash and it's not serving the purpose of revenue generation, then you would think you would give it back to the owner, or give it to the owner in the form of dividends. Then we've got the inventory. Inventory is going to be an asset. It represents the things that we're going to resell. So when we buy the inventory, even if we paid cash for it, we're going to put it on the books as an asset, not an expense. And then we will expense it in the form of cost of goods sold, but not until we actually sell the inventory. Therefore, it's going to be a current asset. So notice all these are going to be current assets here. Current assets is going to be the largest categorization of assets. And then if we were to add up this outer column now, the 14,000, the 39,000, the 26,000, and the 67,000, that'll give us the 146,000. Once again, note that on the 146,000, I'm only adding up one column because there's something above it. I'm not going from the 46,000 and jumping over here to this item. We're not going to be adding things up in two columns typically. These two numbers have been combined together here, 52,000 minus the 13 to give us the 39. Therefore, we're only going to be adding up the outer column here. So notice that what we've got the current assets, colon. That means everything account under that will be current assets. We then indented it to reflect as well that these are going to be subcategories of the current assets, and we double indented then the total, and we put that on the right-hand side, summing up the column. Then we've got the other assets. So we've got other assets, which are going to include investments. So we're saying that these are other investments that are going to be long-term. Why aren't they up here in the current assets? Because we're going to say we have some kind of investments here that are going to be long-term, that we expect them to be to be long-term. So therefore, they're not going to be something that's fairly liquid in that case. Then, and notice this category of other assets typically doesn't have much involved in it. Current assets is going to have a lot there. Other assets typically doesn't have a whole lot. Then you would expect to see fixed assets, which represent like land, building, large items, which could be called fixed assets, could be called property, plant, and equipment, abbreviated as PP&E, sometimes called depreciable assets, although land will be included in there, and land is not depreciable because it doesn't deteriorate over time typically. So here we've got the plant and equipment. So we grouped everything into the plant and equipment. Again, those are going to be things that are going to be depreciable type of things, or long-lived type of things. Things that if we bought like a building or a forklift or a car, then we're not going to expense it even if paid cash at the point in time we bought it, but rather put it on the books as an asset because it's going to benefit many time periods into the future. We will allocate that cost to an expense on the income statement, the timing statement. However, we will do so using depreciation expense. We will allocate it out using an estimate. Because it's an estimate, we're not going to reduce the plant and equipment directly when we make that estimate, when we allocate the cost out, because we want to tell our reader two things. We want to say, hey, look, this is what we purchased it for. We think that building's gonna be useful for 20 years or whatever, and therefore we're gonna allocate it to an expense over that time period, but we don't really know exactly what's gonna happen. Therefore, we're gonna tell you that it's been an estimate. This is how much of the cost has been allocated to the time periods we think have benefited from the use of this building thus far. These are things that actually have been allocated out. The difference between the two then is going to be the book value, or the total fixed asset in this case being the 844 minus the accumulated depreciation of the 877 for the total fixed assets of the 467. Once again, notice the categorization. We got fixed assets, colon, that means everything under its subcategory, indenting to show that subcategorization. We pulled them into the inner column in this case, and then we pulled out the subtotal to the outer column, or the total to the outer column, indenting 2 times it's out in the outer column. Notice this number, when you see this number, nothing's above it. So you're not going to be thinking, well, does that include anything like up here? No, because it has only something to the left, and therefore it's only gonna add or subtract something in one column at a time. This case being the outer column here. So then we're finally going to get to the total liabilities. So the total liabilities, we're going to add up the totals of the categories of the sections of the liabilities that we have thus far. That being the current liabilities, $146,000 plus the other assets. Also note that other assets here, you might be saying, how come there's no categorization for the total other assets? Because there's only one thing in it. Now, if there's only one thing in it, then it's kind of redundant for us to say, hey, look, here's investments, and then here's total other assets, which includes just the $22,000. It would be a little bit redundant to do so. So we're going to say, hey, here's other assets, and then we're just going to put the one item, because there's only one item in it, of the other assets, and then just move on to the next categorization. So we're going to say plus the other assets, which just include investments of the $22,000, plus the fixed assets of the $467,000. That gives us the $635,000. So then the other side is going to be liabilities and equity. So the other side can be a little bit confusing because remember, this is what the company owns. This is the other side of the coin, which just represents who has claim to those, which could be either liabilities, third-party people, or the owners. So this side's going to have liabilities and equity. So we're going to say, all right, liabilities then, same categorization. This is going to be a major group, so we'll center it. We have current liabilities, those that are going to be due within a year's time period, arbitrary cutoff, 12 months. We're going to colon to show the indent, show that it's a subcategory underneath it. Then we would expect the first account to be accounts payable. Those liabilities that we owe in the normal process of business, typically current liabilities, typically due within 30 to 60 days, often from the purchase of things like inventory that we purchased and then owe the payable. So we got the accounts payable, we got the notes payable. This could be the current portion of the notes payable. Notes payable represent things that if the company needed money, needed cash flow, they can do that a couple different ways. They can issue stock, but then if they issue stock, they're giving voting right, equity interest to somebody in exchange for capital, or they can issue take a note, a loan out from the bank. If you take a loan out from the bank, it may be current or non-current, or it could be both, current and non-current, depending on the terms of the loan. If it's due within less than a year, or if there's a portion of it due, the principal portion, within less than a year, that will be the current portion of the note. Then we've got the total current liabilities, which is going to be the $40,000 and the $41,000 for the $81,000 in liabilities, current liabilities. Notice again the indentation here, total indentation here in terms of the formatting. We added up just what was above it. Then we've got the long-term liabilities. Long-term liabilities could include something like notes payable if it was long-term, and say bonds payable. Bonds payable is the other way we can finance the company. Similar to a note, we could say we want to take money from the bank, get a loan from the bank, or a bond is something that we can issue to possibly a broader market of people than simply the bank. So that's another way we can issue something. The bonds will typically, when we first issue them, have a maturity date that's beyond a year, and usually we'll pay off the bond principal portion at one time at the point of maturity. Therefore, it will by default usually be long-term unless stated otherwise. If its maturity date is within a year, it'll be short-term. So then we have the total liabilities, where we will be adding up the total current liabilities and the long-term liabilities. Once again, notice the long-term liabilities only had one item in it, which could often be the case. Therefore, we're not going to say bonds payable and then have another line under it saying total long-term liabilities, because that would be redundant. So what we're going to do instead is just say, hey, look, these are the long-term liabilities. It's only got one item in it. There it is. There's the 216. Total liabilities then being the 81,000 and the 216 for the total liabilities. Then we're going to go to the stockholders' equity. Now, the stockholders' equity, as we think about it, just remember, you could think about it in a generic sense as equity, because when you look at it from a corporate standpoint, you might get confused when you look at other types of entities, such as a sole proprietorship or a partnership. You might say, I don't understand equity when it relates to a sole proprietorship or partnership. Well, you do in total, because because equity is equity. Equity represents the owner's interest. If it was a sole proprietor, you would only have one owner, so you only really need one number there because it's all going to the owner, right? If it's a partnership, Then you got 2 owners, and the partnership agreements can be very diverse. You have a lot of flexibility in terms of one partnership's interest in terms of how they want to make their agreement. So in that case, you gotta break out between the owners, the partners, and you have to do so in accordance with their partnership agreement. And then in a corporation, which we're looking at here, you could have a lot of owners, but the owners have all been standardized, and that's the point. We standardized the owners to represent chunks, kind of like dollars, that represent units of the company that are standard. So we don't even really need to know who the owners are at this point in time to look at the balance sheet. We just need to break out between those standard chunks of ownership that will then be broken out evenly between those owners. So that for the stockholders' equity, we could have preferred stock. Now, the preferred stock, remember, not all companies will have preferred stock possibly, and it kind of muddies the water, the preferred stock, because it doesn't represent traditional ownership. Remember, what it represents is they get the equity, any distribution of dividends, they usually get first, right? It usually first goes to the preferred stockholders, but they don't typically have voting rights, and therefore we don't think of them as usually kind of like the normal owners of the company. They have a preference in terms of getting paid first with regards to dividends, but the amount they get paid will be fixed in terms of the terms of the preferred stock, whereas the dividends to the common stockholder, will increase just depending on how much of the dividends. The more the dividends go, more dividends go out, and then the more could go there. So in any case, preferred stockholders, notice we have the 56 par and 1,000 shares. If you multiply them together, that's going to be the 56,000 for the preferred stock. And that represents us issuing preferred stock and receiving and investment from the basically the preferred stockholders in the company. Then we've got the common stock, which we would think of as kind of like the normal ownership, because the common stockholders have voting rights in the organization. The common stock, we issued 100,000 shares in this case. So 100,000 shares are outstanding of the common stock, and it has a $1 par value. So you would think then that, well, there's 100,000 shares out there then of this stock. That doesn't mean that there's 100,000 owners, because one person can own multiple shares just like one person can own multiple dollars, right? It doesn't mean, because those are just units of ownership. So we're going to say there's 100,000 units of ownership out there. We've also given it a par value, which is an arbitrary value of $1. Why? Because now you can see the relationship. If I see 100,000 here, I can divide it by the par, which is just $1, and I can see that there's 100,000 shares, and that relationship is useful to be able to see. That doesn't mean we're actually going to issue them for $1, because we, the company, are going to issue them for whatever we think they're worthwhile to issue for, the market price. So whatever above the market price we issue for will be the capital in excess of par value, or additional paid-in capital, sometimes called. So in other words, these two represent how much was paid for the stock. So the stocks that were issued, the 100,000 that was issued in stock, what we received, 195,000 of that. That's the owner's investment in the company for the common stock. And then we're going to be looking at the retained earnings. Notice we're breaking this out separately. These two accounts represent the owner's investment in the company, and this one represents the owner, like the preferred stock owner investment. And then we're going to break that out separately from the earnings that have been generated from the company that have been retained. So these represent, this 87,000 represents earnings that have accumulated upwards from the business of the company, income accumulating upwards from the income statement, rolling into the retained earnings account, that have not yet been distributed in the form of dividends. So therefore, when we pay dividends, we typically think of them being paid first from the retained earnings, from the earnings of the company, then before we dig into the actual initial investments of the company. So we're going to keep the initial investments there and then pay out with the retained earnings. And then that's going to give us the total stockholders' equity. When we add these up, that's going to be the 338. And then if we add up the liabilities and the stockholders' equity, that should give us the 635, and it should match the total assets over here. So that should match. Now, if you were to do this from beginning to end, from an accounting standpoint, you'd probably have a better understanding exactly why the balance sheet has to match, the whole way around, because you'd start looking at down to every single transaction that happens that's in balance, going from debits and credits to the double entry accounting system. Here we kind of picked some accounts that already match, and then we've reordered them in the proper format. So when you look at this, you kind of say, well, yeah, it matched because you magically took the numbers that already work and put them into the balance sheet that works. And that's kind of true, but just it's deeper than that, in that it has to work from a transactional standpoint. All these numbers that came about from individual transactions. Each individual transaction was made that was in balance from assets equal liabilities plus equity. So just realize that the balance sheet, has to be in balance. And from a finance standpoint, we just, of course, expect it to be in balance. We know that it needs to be in balance, and then we can use that concepts of these categories to then make decisions on them. So bottom line here, we've got the assets equal liabilities plus the equity. We have our accounting equation being in balance, representing the double entry accounting system in that format. Now, just a couple different formats we can use on this, just so you can see different ways you might want to format this. Here's one's a little bit more complex, very similar. So I'll just do this quickly. We've got the assets. Now I represent it with a colon to represent everything under it's going to be a current asset. Then we've got the current assets, which are going to be represented in a colon because it's a subcategory of the assets. And then we've got the cash, the accounts receivable, the allowance for bad debt, just as we had before. These two being indented further into a third column. Now we have 3 columns here instead of 2 that we had last time. And then we're going to pull this out into the middle column, just like we did last time, subtracting these 2 numbers. And then we have the marketable securities, and then the inventory. And then we're pulling this out to the right-hand side. So this is another way you could represent the categorizations. So now we've got the assets, current assets. Current assets are now being represented, pulling out into another column. And notice, once again, you're only doing something to one column at a time. So this column is over here. Therefore, I'm doing something only with the left column, which means we're going to be adding up the 14 down to the 67. We're not doing anything over here. We're not going to be jumping over to this column. This column was taken into consideration when calculating this 39,000. Then we're going to go down to the total other assets, and there's only one item in it. Because there's only one item in it, we're just going to jump all the way to the outer column. There's no subcategorization that is needed. We'll just pull that all the way out to the outer column. So now we've got other assets and current assets as the only thing in the outer column. And then fixed assets, same kind of thing. We're gonna add them up and then pull the total out into the outer column. So now within the outer column, we have our categorizations in the outer column, which only include the account categorizations, the total assets, the other assets, and the fixed assets. Then when we add up down below, we're just going to be adding up the 3 numbers that are up above it, which are all in the outer column, and that's all that's in the outer column. So some people like seeing it a little bit like this way. It's a little bit more clean. It takes more detail to do it. It takes more space. You get a wider kind of financial statement that you need. You need more columns to break out this more kind of detailed look. And then some financial statements will like to trim it up, which means they'll put a vertical type of format. On the liability side, you got liabilities, current liabilities, then the accounts payable. These are the current liabilities, accounts payable, notes payable on the inter column. And then we're breaking out the total liabilities to the outer column this time. And then we're going to say long-term liabilities. We only had bonds payable, therefore it's going to be in the outer column, and that's all that's in it. Then we've got the total liabilities that we can now add up simply the outer column. Total liabilities, bonds payable. You can even see this being in another column. You could make another column and put total liabilities to the right? Make it a longer, and it looks a little bit, cleaner to some people that way. But then you got the stockholders' equity. That's going to include the preferred stock, the common stock, the capital in excess of par, retained earnings, which will then be grouped up in the outer column once again. And then we'll sum up the outer column, which will include these 2 numbers. There's the 635 and the 635. Okay, another way we could see this, we could say, okay, what if we want to condense this thing? I don't want this super wide thing. I want to see it, fitting on one column. I want to be able to put something next to it maybe. Well, then we don't want to see it in a vertical fashion. We'll move this whole thing, liabilities and equity, below the assets. So it's common to see it in that format as well. So in that format, same thing. You just got the assets on top, and you can just have assets. There's nothing, liabilities aren't to the right, they're going to be below. So we've got the assets, we've got the current assets, we got all the current assets within it, same format that we had in the first one. It's just all in one column now, so you can see it, all in one space. This way you can focus in on the current assets a little bit easier, but you can't do the comparison to the liabilities as nicely. And then current assets on the right, and then we're going to have other assets. There's the investment. Then we're going to have the fixed assets down below, bringing us down to the total fixed assets, and that gives us the total assets. And then liabilities and equity, instead of being to the right, will be down below. So we have liabilities, current liabilities, including accounts payable, notes payable. And so those are going to be those items. And then we've got the long-term liability, the bonds payable, total liabilities, that. And then we've got the stockholders' equity, which is the preferred stock, common stock, capital paid in excess, retained earnings, then the total equity, pulling that out to the right once again. And then we've got the total liabilities and stockholders' equity. So it takes a little bit more looking now. You got to understand to see this vertical format. You can't see it side by side. You got to be able to say, okay, I know what I'm looking for. I'm looking for total assets, which is this $635,000 needs to equal the bottom line of liabilities and equity, this $635,000. So you can still see it's in balance, but it's not quite as nice and side by side in that format, but it's very common for financial statements to be presented in a vertical type of format such as this as well.